The markets have been absolutely relentless lately, haven't they? They've tested our portfolios, challenged our conviction, and really shaken our emotional resolve. But here's what separates the opportunists from the panicked. They understand what the banks are quietly signaling right now. The Federal Reserve is cornered, and when central banks face real constraints, history shows us exactly what comes next. The money printers wake up. The last time this happened, ordinary people turned modest investments into generational wealth. This time could be different, but only if you understand two critical indicators that most investors completely overlook: the EFFR and the SOFR. These aren't just another pair of overhyped crypto projects promising the moon. These are the silent architects of liquidity in our entire financial system, and right now, they're flashing yellow. Let's start with the EFFR, the effective federal funds rate. Think of it as the heartbeat of the U.S. financial system. It's the overnight lending rate between banks, the core mechanism through which financial institutions balance their books every single day. You see, regulators require banks to hold a certain amount of cash in reserve. When a bank finds itself a little short at the end of the day, it borrows from a bigger bank that has extra cash. This overnight lending creates a market rate, and that rate is the EFFR. Unlike a car loan or a mortgage that stretches for years, these loans settle within 24 hours. The interest paid on them becomes the benchmark that ripples throughout the entire economy, affecting everything from your mortgage rate to your credit card APR to the sheer amount of money flowing through the system. When the Federal Reserve adjusts its policy rates, the EFFR is what they're actually targeting. A lower EFFR means money is cheap and abundant. Markets love this environment, especially riskier assets like cryptocurrency. A higher EFFR means capital is scarce and expensive, and risk assets tend to suffer. But there's something even more revealing happening right now, and we find it in a different measurement altogether. Enter the SOFR, the secured overnight financing rate. If the EFFR is the financial system's heartbeat, then the SOFR is its blood pressure. It measures something fundamentally different: the cost of borrowing when real collateral backs the loan. Specifically, SOFR tracks the rates for overnight borrowing when U.S. Treasury securities, the safest assets on the planet, are used as a safety deposit. This involves the biggest players in the game: hedge funds, asset managers, multinational corporations, all competing for overnight cash by offering up their treasury bonds as collateral. Here's the critical difference. The EFFR is mostly unsecured lending between banks. The SOFR involves a much broader ecosystem of financial institutions and requires actual, tangible assets as backing. This technical detail reveals something profound about market psychology. So SOFR doesn't just blindly follow the Fed's target rate, because it's driven by real market sentiment. How nervous or confident the major players actually feel about liquidity. When confidence is high and cash is flowing freely, the SOFR typically trades below the EFFR. Lenders are happy to accept slightly lower returns for an ultra-safe collateral-backed loan. But the moment stress enters the system, when fear grips the markets, everything changes. Cash suddenly becomes king. Even supposedly risk-free treasury bonds start to look a little less certain. Lenders demand higher compensation for their capital, and the SOFR climbs above the EFFR. This spread, the difference between the two rates, acts like a financial seismograph. A negative spread whispers stability. A positive and widening spread screams that the system is hoarding dollars and that trust is beginning to erode. As of October 21st, the EFFR stood at 4.11%, while the SOFR reached 4.23%. That creates a spread of about 12 basis points. Now, that's not panic territory, but it's enough to turn on a yellow caution light on the Federal Reserve's dashboard. Jerome Powell and the FOMC are absolutely watching this. For those who've studied financial history, this all feels very familiar. Back in September 2019, the system experienced a genuine stress event. The SOFR exploded from 2.43% to 5.25% in a single day, a dramatic spike, while the EFFR barely moved. The spread detonated from 18 basis points to nearly 300 basis points overnight. Corporate tax payments and huge treasury settlements suddenly drained the system of cash, forcing banks into a desperate scramble for dollars. Only emergency repo operations from the Fed managed to restore calm. Today's situation isn't that intense yet, but the trajectory matters more than the current reading. And here's what's genuinely crucial to understand. If this stress widens and SOFR keeps climbing, it's not catastrophic for us. In fact, it's quite the opposite, especially for those positioned in digital assets. When these liquidity metrics get worse, the Fed faces a choice: keep tightening and risk breaking something, or switch gears entirely. Quantitative tightening, the process of shrinking the Fed's balance sheet, might be ending soon. But quantitative easing, the money printers roaring back to life, is what really matters for asset prices. Jerome Powell has already hinted that QT is approaching its endpoint. He hasn't given a date, but he acknowledged the Fed is nearing its goal of having ample bank reserves. More importantly, Powell noted that recent labor market data is showing a meaningful slowdown. Unemployment has ticked up. Wage growth has cooled off. Job openings have declined. These aren't flashing red recession indicators yet, but they are moving the Fed's dual mandate, controlling inflation and maintaining employment, back toward a balance. Still, the risk of high inflation and the risk of a recession aren't equally weighted anymore. This rebalancing sets the stage for rate cuts, and likely multiple ones. Markets are pricing in almost certain 25 basis point cuts at the next two Fed meetings this year. That could mean 50 basis points or more in total reductions. Lower interest rates make borrowing cheaper, increase the money supply, and most critically for our thesis, they make holding non-yielding assets like gold and cryptocurrency far more attractive. When you can earn 5% risk-free in treasury bills, why would you chase Bitcoin? But when those rates collapse towards zero, suddenly that Bitcoin looks like a genius move. And if rate cuts are on enough recession risks pop up despite lower rates, then quantitative easing becomes the logical next step. The Fed will start buying treasury bonds and mortgage-backed securities from the market, injecting hundreds of billions of new, printed money into financial institutions. History shows us exactly what happens to risk assets when central banks unleash that kind of liquidity. The evidence is all around us. Gold is trading near all-time highs, but not because retail investors are lining up at coin shops. Central banks around the world are buying gold at record rates because they're losing confidence in the US dollar and the safety of treasury notes. That's the real story. The smart money and institutional players saw years ago that unlimited debt and currency printing will eventually devalue fiat money. They are positioning themselves accordingly. When the Fed switches from tightening to easing, that same dynamic will accelerate across risk assets. We saw it play out perfectly in 2020. When the market crash forced the Fed's hand, they fired up QE immediately. Bitcoin went parabolic. The price exploded. People who got in early saw life-changing returns. The macro setup today has remarkable similarities. We're at an inflection point where funding costs are rising, liquidity is tightening, the job market is cooling, and the Fed is signaling a pivot from hikes to cuts. The convergence is incredible. Interest rate cuts are coming. Quantitative tightening is ending. Central banks globally are either cutting rates or starting their own easing programs. On top of that, the regulatory environment for crypto has completely transformed. Institutional money that was locked out 5 years ago now has legitimate on-ramps. Bitcoin and Ethereum now have real financial infrastructure futures, ETFs, and custody solutions. The pieces are aligning for another explosive move. Of course, markets never move in a straight line, and volatility will test your conviction. There's never a guarantee, and a healthy dose of skepticism is always wise. But the probability has shifted decisively in our favor. Even if full-blown QE doesn't happen right away, the rate-cutting cycle alone should trigger significant upward momentum. Risk appetite naturally expands when capital gets cheaper. This is the Goldilocks zone. Not too hot, not too cold. Everything is pointing toward a parabolic advance. The Fed is cornered. Liquidity pressures are building. The labor market is cooling. And the only historical solution to these conditions is fresh money printing. The last time the Fed turned on the money printers, those who were paying attention prospered enormously. That window is opening again. If you're the type of person who likes to stay ahead of these cycles, the time to pay attention is now. Because when that flood of liquidity comes back into the system, it won't wait for the latecomers. The smart money is already making its move. The only question is, will you join them, Or will you be watching from the sidelines as history rhymes once more? Thanks for watching, everyone. If you found this breakdown helpful, do me a favor and hit that like button and subscribe for more deep dives. See you in the next one.